How do you see the silver market playing out for the rest of 2026 and beyond?
There is clearly a debt-based collapse. Inside of that, you could initially even have a sell-off in a disinflationary event in metals and then a super surge. We are now in the red zone since 2020, where everyone's had that amount of time to work out that the reserve asset of debt is no longer truly being seen by central banks as a true reserve asset. That's the sudden point of convexity. That's Weimar moments. And that is absolutely saying 300 to 1,000. You can even go, 1,000 to 50,000 because the dollar is now in, Argentine peso territory, Turkish lira territory.
Francis Hunt, great to have you back on Commodity Culture. I want to start things off by getting your view on the silver market because I just had Michael Oliver on the show and he said his old price target of $300 plus silver, scrap that, we're going much higher. And he said he wouldn't be shocked to see us hit $1,000 silver sometime in the next year. This isn't way out into the future. Of course, the furor that this has kicked up online, both on X and on YouTube in the comments section, is very interesting to see. Most people calling him crazy, out of his mind. Let's get to 100 before we start talking about 1,000. I wonder what your thoughts are here. Do you think his targets are realistic? And how do you see the silver market playing out for the rest of 2026 and beyond?
Yeah, so I don't want to start passing judgment on some other analysts' work, especially if I don't know the assumptions. We like to think of ourselves as the biggest bull, but I think in terms of time frames, Michael certainly usurps us. I want to, in a separate vein, without directing this at the person you mentioned at all, say there also is a tendency for what I call the sort of Max Kaiser syndrome, where it turns into a kind of pissing contest of who throws out the biggest number. Again, I hasten to add, it's not an accusation being cast at Michael directly. You've got to have a foundation for what, you're putting forward. Ours is technical. We have a method and we have projected targets. So we will never say a number just because it's a nice round headline grabbing number. If it is, it's because technically that's what it generated. So we made the forecast well before Michael and others. So again, it's not about the person you chose to mention there. I don't want to wade into a brawl with other people's opinions, particularly. We said 333 were in the Jerusalem Post quite well before Michael Oliver's controversial call for $300. The one difference we made is we didn't cap ourselves on time frame. And there's a number of reasons for that, because our targets are generated technically, and we have a long stop time date by when they should perform, and it's very far out. Typical HVF breakouts sometimes only use 5, 10%, 15% of that time, but it's a variable we have very little control about. And I've found from my own, as someone who puts numbers out there and forecasts in a public space, there's no point in putting your head through a noose on something you don't have real control on. Sometimes when we see, particularly now, there's a lot of behind the scenes debt contagion that is going to lead to destruction of fiat and debt. And Michael could well prove accurate, by the way. But that is a X factor variable that I can't put my thumb on. So in my opinion, this whole JPY crisis was actually a US debt-based crisis when Japan needed to sell treasuries. Forget the narrative you're being spun. They create the story for you. You see this with Fauci on injecting experimental medicine into pregnant women. They spoke one language, it's no red flags, and then internally they were speaking something entirely different. In fact, they're usually the inverted corollary. So the statist organizations, whether it's health, wealth, or anything, have a habit of having duality, a duality of morality, I like to call it. And our game has always been the inversion perversion, decoding the signal and getting to the right answer. So in my opinion, we had Japan wanted to sell treasuries. We got rates running on the 10-year, the 30-year, showing that the market is not that liquid. Remember, it's a 24 trillion market cap from 1 year to 30 years. It's absolutely huge, but clearly there is a check out anytime you like. but you can never leave Hotel California syndrome by the time you yourself own a trillion of those bonds. Your hand's too big in that cookie jar. It ain't coming out unless you drop all the sweeties. That's pretty much how it goes. So for me, there is clearly a debt-based collapse. Inside of that, if you suddenly have a complete sinkhole, you could initially even have a sell-off in a disinflationary event in metals and then a super surge. And all Michael's predictions, or anyone else for that matter, as I say, he's not part of my discussion or analysis in that sense, could indeed come true. We are a lot closer than we've ever been. And many people will tell you, but they've been holding it together since the 80s, all of this. Here's a key point on that might play into Michael's hands in terms of the risk he's taken in time frame, which I prefer not to take, is that post-2020, the bond market turned, and that is irrevocable. And we've said many times, it's the most important call we ever made in September. It's not the best, it's not the wisest, whatever, it's no degrees. It's the most important for reset. It is the point where nominally bonds are failing to go up in value anymore, and interest rates continue to typically grind higher despite everyone's best intentions, despite a weak economy maybe for retail, despite a lot of things, because when debt devalues, it's absolutely one half of the seesaw that sees rates go up. And just for the dollar milkshakers, and then I'll hand back, dollar was supposed to go up on rising rates. And normally in a strong economy where you are not got a debt-based crisis, if the dollar in America is growing strongly and the Fed is increasing rates, you actually get a flow of money into the dollar and into T-bills that sees both the rates go down, the bond values go up, and the dollar strengthen because of liquidity attraction. What we've actually seen in the Besson event with Japan is that just the possibility, and we don't know how much actually got sold, we don't get to see those numbers, of a major nation that is a holder trying to check out of Hotel California USTs led to the debt valuations going down, rates spiking, and the dollar went down on that. Rates going up, milkshakers supposed to suck all the money and all the liquidity of the rest of the world. No, it's a distress. There's a different kind of rates go up, and that is a distress-based one. And that's what happens when you excessively overborrowed. That event, if it goes into complete contagion, could bring Michael home. So people who are mocking him or getting involved in a brawl, he may end up being correct, and he will have taken a big risk on timing because it has gone on for long. However, I highlight, we are now in the red zone since 2020. We're 6 years now where everyone's had that amount of time to work out that the reserve asset of debt is no longer truly being seen by central banks as a true reserve asset, and rates are being supported at these levels, and bond markets are being supported by everyone can buy, but hey, don't sell that. We'll let you lend against it. Hey, don't sell that. Now, price discovery mechanisms are based on freedom to buy and sell in reasonable size on an ongoing basis, where the price discovery mechanism does that. My opinion, and quite possibly Michael's reason, although you best ask him for why, is that not being a true market actually means we're maintaining a Ponzi, and at any moment it could go down, and then his timing opinion will come home. By the way, he's also not the first to say 4 digits. He may have been, who knows? It's not. I don't follow all his forecasts, but we've said the same. After our 333, you get 4 digits. In fact, we've called for single-digit gold-silver ratio, which will almost certainly see 4 digits in silver, but we've given it to you in a different way, without a time stop, because I can't 100% say I can put a handle on when it all blows up, but I will say we're in injury time.
The sponsor of today's episode is ARC Silver Gold Osmium. Owner Ian Everard is praised even by his competitors as one of the most honest and level-headed bullion dealers in the United States. They have some great prices. You can see some of them displayed right now on screen. Take advantage of these specials today by reaching out to Ian at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell him, of course, that Commodity Culture sent you. And now, back to the interview. Yeah, some great thoughts there. And just to clarify, Michael didn't say categorically silver would go to 4 digits. He said he wouldn't be shocked, but he did say it's going much higher than 300 within 1 year's time. So should be interesting to follow along with his forecast and see how it all plays out. What are your thoughts here on how gold and silver have reacted to the war in Iran kicking off, and where we are today? Because we initially saw a sell-off. It seemed to want to break out both metals, struggling to do so. Now we're starting to see both silver and gold rise, while the broad market seems to be in a bit of a purgatory in the moment, just kind of moving sideways or very slightly down over the last few trading days. What sort of data are you drawing from this information over the course of the war and where we are today when it comes to both gold and silver?
Great. I hear your question on the war and I aim to answer it. I just want to tag on a final little bit piece onto the once you've done 300 going 1,000 and beyond, as a final full stop on that whole discussion. When you are in the convexity phase, you need to think of it as a graph. This is a faith-based system that has been eroding slowly. Suddenly it steepens when the masses, the normal curve, realize that you're in an unsustainable system. You, I, Michael, and most of your viewers are in the early adopters part of the normal curve. Metalheads generally are and have been warning this is coming. Mainstream land and their wealth is still sitting in mainstream land assets. So once you get the tipping point, you get complete convexity, a very fast steepening. So he's absolutely right, and I concur with the theory, and we have had and spoken of this ourselves. We called it the Ernest Hemingway bankruptcy curve. You go slowly at first, which is since 1980 till today. The degrading has been compounding against you with a negative rate, but it's been, it's that drip poison to suddenly very fast, as Hemingway described his bankruptcy. That's the sudden point of convexity. That's Weimar moments, and that is absolutely saying 300 to 1,000. You can even go, 1,000 to 50,000, because the concept of the measurement, the dollar, is now in, Argentine peso territory, Turkish lira territory. And that is almost meaningless as a benchmark, but he's correct about its loss of valuation. Let's go to the Iran part of that. Here, in fact, I've got a chart share. This was our reading. I think we've played this period reasonably well. We don't always get everything right. This is the falling wedge, which was a continuation pattern for gold. So this is what happened throughout this period. Of course, the Hormuz kind of warmed up tail end of January into February. We had a very, very strong September. So I was in London and I was walking around Hyde Park and warning that this would be an upside break, having also warned at 2,000 we would run to 3,000 quite promptly on the once, twice, three times a lady. We dropped these catchphrases in so that people can remember we said that. And this has been the trend. You had a little blow off when you first ran to 4,000 and a minor correction, then you continued with a move up. You also had the twitch factor where you made the new high, you got the dump and you got flash bought again. That was the first warning of a bit of nervousness, by the way. And we did on the last day of January, before going to ride in the Karoo, alert our entire community to great controversy, also put out an X post. And everyone said, you never came out on YouTube and warned us, all the free views, real angry. Anyway, say that we're exiting all our leverage long. So we'd had an incredible run from late August, September, all the way through to the end of January. It was incredibly profitable. We had a multitude of our community become millionaires for the first time. And then they closed, importantly, the ones that were listening, which was most of them. And then we went into this pullback that has been longer than people cared. But people have to realize that 2000 break, around about November 24, I think it is, I can go and check it, you've gone almost non-stop till January 26 to 5,600. That is incredible for a very big market cap. You're talking 30 trillion market cap. I don't know if it is right now. That might be just under, might be just over. But I'd have to do the maths and check. So anyway, the war brought oil into the equation. And that meant the Eastern surplus nations that were stacking gold had to now concern themselves with energy and how deep their supply chain was for potential breakdowns in the supply chain of energy. And most of the nations running surpluses with the US, Japan, Europe, and China are not energy independent nations. And by the way, the US seeks to sell gas and ended up engineering a replacement for Russian gas. That's right. Europe, instead of taking a pipeline that's from a neighbor, now ships liquefied, very expensive process, on a boat across the Atlantic to dock it and to deliquefy it to have gas. I mean, it's absolutely insane, but you make of that what you will in terms of the German, particularly driven energy policy that has destroyed industry, destroyed companies like Porsche and Volkswagen's profits. Separate discussion. Hormuz, though, by pushing the oil, created an adversarial relationship for a spell between oil and gold, because gold is the long-term wisdom, important saving, but oil jumped in front of it and became urgent. It's not a retainer of value. Many people say, as for gold, so for oil, as if they are interchangeable. There is more scarcity to gold. It's getting more expensive to find. You would say the same to some degree about oil, but I do not assess we've ever had a peak oil situation. It's in abundance. It's not lazy age dinosaur bone juice. And we've run out of dinosaur skeletons. There's a lot of misnomer, the whole fossil fuels narrative. People need to wade their way through that. There is cost for extraction, and it is a commodity, but gold is money, and oil is not, and it's energy. So overall, there was a substitution for a spell because of the urgency that oil represented. However, as things have settled, we have worked through that. It's been about since the high here, end of Jan, and we were watching this 4,000 key level of significance that was holding. We talked about the 3 impulse falling wedge, which is unique to HVF method. There it is. And then you had the 3rd impulse here, and we were expecting a falling wedge break. And we had the smaller pattern. This is a weekly chart of gold. We had the smaller pattern, and we did the video. We even gave it to people on free view. They wouldn't have been the first. If you're in our community, you get it first. But we showed everybody this is most likely to break upside. We expect it to be midweek next week. That was last Wednesday we were referring to from the Friday before. And that YouTube remains up there. So we were buying aggressively long here. And we benefited from a beautiful spurt. I will point out you had the key spurt. Then you have a secondary spurt, not quite as big, a bit more churn, and you get another spurt. It's marginally higher high and down. So people should watch out a little bit. I've actually reined back my leverage longs. We had a lot of leverage longs. It's worth proving we actually trade the markets. We don't throw out opinions. There's a couple of the entries on different platforms, for example. That's where we bought. I've reined them all back. I took snapshots of them. Because we get people, want proof of concept. We trade. Those are our entries. That ended up our trailing stops. Those are all largely closed. Those were entries over here. You are losing some of the momentum, and we have a CPI number to come today. So there's a slightly greater risk. CPI is due to come, and personally, I think it's a CPI number. As I joke, many others do the same. We don't trust it. What's the problem for Besant? Bonds. Rates going up, value going down. In actual fact, if he gets rates to go down, normally bad for the dollar, because we have this distress vibes, if bonds calm down, I expect actually dollar will firm a little. Totally contrarian to what is normally the case, because this is not a healthy market situation. It's a crisis situation that's not been told to you as a crisis. You've been told, keep quiet and carry on. All the doomers, ignore them. Everything's under control. We're just helping Japan. All the cope that they feed you. But in actual fact, if we undershoot on inflation, I think it will be in their best interest to manufacture a number that is equal to the CPI. So if you ask me to guess the data that is coming out later today, and it's 12:47 here in Cyprus, and it'll be out at 3:30, the CPI number, I'm going to say the year-on-year will meet or be below, because that's what they need. And the CPI year-on-year will meet or below the expectation. So that's a CPI number of 3.4. I say 3.4 lower rather than higher, even though I personally assess inflation to be far higher than what they say, and not necessarily declining at all. They get what they need. Besant desperately needs the pressure off the 10-year, and the Trump pushing up the oil price on Hormuz stories and pushing up costs via your primary question, which is all about the escalation in the war, was in fact inflationary and helped contribute to the crisis Besant now finds himself in. Don't forget, Japan needs to buy oil, gets a lot of it through Hormuz specifically, and making it more expensive for Japan has pushed their inflation, which has seen them want to repatriate their treasuries. So in an interconnected world, that was a foot shot. Going along with Bibi Netanyahu's attack on Iran was a shot in the foot for Americans themselves, American inflation, and the tenuous situation of having lots of other people own your debt. So let me hand back.
I want to talk about gold and silver miners as well, because yourself and many guests on this show very bullish on the metals. And so it would stand to reason that the miners, a lot of them looking very undervalued at these levels. We even saw some of the big producers, the biggest and the best producers, fall rather dramatically after reporting record earnings in Q1. Now, of course, the miners are also reversing course a little bit and heading to the upside, much like the metals themselves. But I'd love to get your thoughts here on if you think this is a good entry point for taking a position in the gold and silver mining space.
Generally, I'm a fan of miners. The only reason why I have put metals beyond miners is certification and the great taking. In terms of making profits, whether you get to realize those and take them home if we have a counterparty risk failure and all of that, that's the risk that worries me. In other words, I have abnormal situational risk, the same kind of risk that will spike metals as per Michael's potential projection that you were mentioning. If we look at the falling wedge here, very similar to the precious metals itself.
So you're using Hecla Mining specifically as an example here.
I chose Hecla because it's big in silver, and I'm sure you've got a lot of silver heads. Note how the $4,000 gold had a bit of a flaw. In silver, it was around 55, 56, and here in Hecla at around $14. So it's broken out. That was one example. But I mean, if you just take the GDX juniors, which have done famously well, that's gold miners. I don't know how whether there's enough volume in Silved. We'll have a look at it. But very similar falling wedge, great breakouts. The problem you have is this is not a great trading tool because of the gaps. It's a great investment tool and to stay long. But I think this period of continuation pattern that was eroding to the downside has triggered and popped. But the ideal entry was, again, when you were holding a level here at about 95. On the gold miners junior ETF, if that's what you want. For investing, again, I would prefer to have the stocks, and I'd prefer to have stock certificates than an ETF. But we're just looking at this as a general proxy. Let's have a look at Silge, which is the junior silver miners. I mean, the market cap here must be very small. You can see how it's the same. And that's a beautiful falling wedge and a beautiful break. Note the gaps, though. If you get it wrong and you have normal stop losses or stuff, you could get hurt on the downside. It's going to be higher volatility. If you're an investor and you're comfortable with ETFs, I would caution on that front. Generally, you could buy and hold this as a blue pot holding and just try and manage for your counterparty risk. I prefer to have a certificate of a number of silver miners. And for that, there's quite a few you can choose from. First Majestic is always pursued ounces in the ground aggressively. Fresnillo is a very big producer. There's also platinum miners to think about if you're okay with the white metals. So there's quite a broad discussion, but they all seem to have fallen into the same kind of pattern. You note I haven't changed the draw, and they're all fitting. The hand fits in the glove that has been drawn. So the story remains pretty much the same. It's about the silver price. Some of them have overpopped relative to others. In other words, they've been better jacked and more spring in their step as they're coming out of the falling wedge. But there's one key point that where I differ a tiny bit potentially from Michael, or not that he can't be right. I think he can be right, but I think you also have to weigh the possibility of a major demand destroying event on tech and the hyperscalers, and the amount of skullduggery that is very much subprime 2.0 vibes that I'm getting. We're just less aware of it because it doesn't involve retail and strippers buying 5 buy-to-let apartments now. We've been sort of insulated from the in-between borrowing by private equity, private credit, which is a fancy word of saying opaque and not very transparent. And you already have investors that have been locked out of the fund. And you now have the debt markets where effectively there's a soft lockout for excessive selling. Californian Teachers Association was forced to borrow when they needed to sell treasuries to make a payroll. The Gulf states got instant swap lines on your Hormuz question when they lost all their tourists and their oil income was damaged through bombing, instead of being allowed to sell treasuries. So it is, I warn about this Hotel California syndrome. It's not a symmetrical market. The bid and buying is welcomed, the selling is not. And there was a staking token called Hex, where the owner and founder just had everyone buy and promote, and then insisted the smartest thing to do is to stake, so that those buyers never became sellers. And he managed to run a micro cap to a theoretical valuation of 77 billion. In valuation at its peak at 50 cents when it started at a fraction of a cent. So this is the fallacy of market cap. If untested by reasonable or at least a decent percentage of the market cap in buying and selling by independent parties on a regular basis does not occur, you are having a managed market cap theoretical valuation. It's a very theoretical valuation. So I want people to bear this in mind, and that's where the debt market is. So I think if you get a bit of a crush here, I don't assess necessarily we're at new highs by the end of the year, as encouraging as this is, because I think there's other volatility and other stories that will potentially lean in on this. I would say you're a 25% probability that, silver's through 121 and gold's through 5,600 by Christmas Day. And all these stocks are well through that. I would say the majority is we're probably in range where we are. And there's even a small possibility, I wouldn't put it as high, but you have to keep multiple scenario potential open. If you have a major demand destroying event, September, October, you could even be below this shortfall floor level. That would be an absolute buying opportunity in the metals space, but that will be a situation where people have to sell anything because they've got to, for margin call reasons and a variety of other reasons. Don't forget, Russia sold some gold. I think Turkey sold some gold during Hormuz when they needed to just deal with quick liquidity. So people that have to. And it's the stuff that's always wanted that gets sold, and it can dip in price during that period. So let me hand back.
Yeah, great analysis there. I want to talk about Fort Knox and Senator Rand Paul visiting recently. He had a quick look around. He said, it's all good, guys. All the gold is here. Now, somehow in a few hours, supposedly he was able to personally count all the gold himself as well as test it for purity. A very, very impressive feat. What are your thoughts here? Should we take Rand at his word, or is he just towing the party line to convince the American people everything is fine and dandy?
Yes, I actually dealt with this quite clearly. It's not a non-serious walkabout, talkabout, PR type situation. There was our friend Brent Johnson that says, you guys can't not believe the US has the gold, but at the same time believe that America, China and Russia does, almost as if there's a symmetrical situation. This was his comment. I'm hoping you're still sharing screen here. And this was our response. So we gave quite a detailed response. his comment is on this Kentucky, is Kentucky, Rand Paul. Believing China, Russia does have all the gold they say they do, plus more, despite no audits, while at the same time believing the US does not have the gold, is a good example of those who like to point out psyops getting psyop themselves. So on the surface, that sounds a very smart observation. That's where you typically apply the law of symmetry in all directions. In actual fact, there's two different parts being played here. There is the aging bodybuilder who took steroids, still big, still kind of muscular, but a little bit sick and yellow, jaundiced around the eye, still trying to show he's the king of the pub, swinging his pool cue and threatening folks and saying, I'm the baddest man around here. And there's the younger wannabes that are healthier, fitter, but are hiding their muscles and their workouts under big, flabby clothes and keeping their heads down and are in stealth mode. There is no symmetry here, and I responded to this in grand detail, so it's ironic you answered. There's no symmetry at all. One is fading into the dying light, the other is creeping up, seeking stealth and understatement. They don't want to be seen as a too big a challenge too soon. They're too busy stacking. They're too busy getting stronger, too busy building. They don't want this thing to blow up. They're like, hey, we ain't got no problem with the big ass bodybuilder. We're just quietly getting stronger and doing what we do. And I would actually say understatement is everything that's come out of China is a gross understatement. You're meant to believe they have a couple of thousands in here. And I've gone into rhyme and verse. The asymmetry is the point, 100%. One is trying to act tough to keep heads down, and the other is trying to look weaker than it is. That's the art of war. It's absolutely Chinese wisdom. Act weak when you are strong, especially as you're getting stronger. And the best wars are ones you don't end up having to fight. He will fall under his own weight. You might not even have to hit him and run the chance of an assault charge. All of those things are actually applying. So it's a fascinating discussion. Nothing Rand Paul did was anything close to an official audit, and they have continued to balk at the opportunity to put that monster to bed. In fact, all they do is continue to feed the outlying feeling by always doing PR type Photoshop moments that have no bearing on a legitimate certified. And in the language, it is deeply non-committal. We also covered that. So you went, you looked, you did nothing, and you said, hey, all looks grand, without committing yourself overly. Well, that is absolutely what a fraud would be like. People will continue to hold the line until it's forced on them without overcommitting themselves. Again, I point you to Fauci's overcommitments that are now coming back to bite him, and vague language. So it is in America's best interest. By the way, last 5 months, record sales of gold, well beyond any level of production, going from America via Switzerland and via Hong Kong and directly via Beijing into China. For 5 months, the only reason you didn't have a new record deficit, which you had at the beginning of the year, is because in the product category, the biggest export from America is gold. And that is huge. And I like to remind people of why there is a real trade deficit problem. You look at the European Union over here and you'll see there's a deficit of trade of 223. Mexico, think China, Japan, and offshored production as well, 203 billion. Vietnam, very similar, diversified out from China. And then China and Hong Kong itself at 173. You have a real deficit problem. You're having to give away gold, real money, for the fact that you don't sell enough to those nations of American goods. That right there is a structural problem that won't go away, and it undermines the dollar. And for those in other exchanges with our milkshake maximalists that said, well, we're up, the dollar's actually up for the year. Well, we're talking about the last 2 weeks. It's chronically down. Second of all, it's at 99, which means since issuance, it's even down. Third of all, the dollar index is the most leper colony comparison. You're comparing yourself purely mainly to the euro. You've got the Japanese yen and the pound in there, when in actual fact, your largest trade deficit nation, if you count Mexico as part of China, is in fact China, and you should be looking at the USD versus the CNH. So there's a lot of funny analysis here since the beginning of the year. That's how you're down against the CNH. That is the Chinese yuan. That is your biggest essential trade nation. If you say, well, some of it's going through Mexico, what about the Mexican peso? Well, here's the dollar against the Mexican peso since all that manufacturing got put in Mexico. This is the performance. Let's get that same performance from the beginning of the year. So the dollar is losing. Here it is. How are you done? That was the beginning of the year. That you are watching the dollar decay against its biggest trade nations. So no, the dollar isn't up for the year. The crisis was the last 2 weeks. It was violently down against all currencies in the last 2 weeks. And even year to date, if you do a true weighted trade basket index, not the dollar index of leper colony Western nations that are all going to collapse together, which is largely meaningless, you compare it to those that are selling you the stuff you need, you are down, 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 and your yields are higher. That is not milkshake land. That is distress on the debt and the dollar. Now, you might get a bottleneck, and you could have a situation where you do get a once-off spike. We've never said it can't happen, but the real trade is gold. Any talk about the milkshake is trying to make a dollar, a momentary spike in dollar, a key thing. Good luck if you think you're going to catch it and trade it. You need to protect your capital. We're talking about a collapse. The only thing that does is physical metals held in your hands, not ETFs, not anything else. This piece of silver is always on my desk. It never gets smaller. It doesn't rust. It stays there. It has the same numbers it always had on it. It weighs the same. That's what you want for seeing this thing out, Jesse. It really is. So I threw a lot in there, but hopefully it's interesting for you.
Yeah, absolutely. And I didn't really like Brent Johnson's response there. You know, I follow Brent Johnson, and I think he says a lot of smart things, and I agree with many things he says, and I disagree with others. But to compare it that way and say, well, we don't know China and Russia's numbers, so you should just believe America's numbers because some senator walked around. I mean, that doesn't make sense.
Well, they're not the hegemon. They're not playing the main guy. They're not playing the world currency. They don't have to disclose. I mean, who else do you know any level of honesty with audits on their metals? If you're putting yourself forward as saying, trust us, we are the global currency, you're the one that has to prove. There is an asymmetry. If I say I'm the leader, I must show that I won all the battles. I was a great general. I must have that history. I must be able to prove it and that I'm worthy. And in that sense, America doesn't. And by the way, known liars lie. And Nixon era was printing fiat for the Vietnam War, where it was not backed, where they were supposed to be running a fully backed system. And they cheated and lied, and the French caught them, and the rest of Europe caught them and asked for their gold instead of the paper. So you already have a history of dishonesty. Sorry to say that. It's not a projection on the average American citizen. It's on the cartel, the transnational cartel that runs the system and lies on your behalf. That's what led to it. And so, known liars lie. And if they're proven liars, don't trust them. And that was no audit. It was meaningless fluff. And I don't even know why they chose to do that, because it doesn't add value. It takes away. It's just further confidence in the non-audit approach, which Trump and Elon and all of them promised. And they just started to have that one go to sleep again. And now they've reawoken it. And Besant even had a comment. So, in terms of the gold, we don't feel we've done too bad. We said you're not getting a reval when everyone was expecting July the 4th reval. So you won't get that. It doesn't serve America to do it. Why would they do it? There were a swathe of YouTubes about reval. A lot of people on the 24th said when the China system goes live, I said it'll pass like a dead parrot. It's more significant for the long term, yes, but you're not going to have an event on the 24th. It's not going to happen. We said this is the bottom. And we bought But I don't know if it just means you rip to new highs from here. I've already closed a large part of my leverage longs on here, and I'm watching. There's a CPI number. If they bring it in soft, you might go a little bit more. But there's also a return move on any falling wedge that's broken. And we have now broken and run really hard. We've made absolute fortunes out of just this short move recently. We're very lucky. That's what HVF method does. Now we take it, we bank our profits, and we watch for the next. It's not a low risk, high probability trade anymore once it starts getting into the thick of the range. We could finish the year anywhere between 4,000 and 5,500. That would be probably my majority bias. You can 20% maybe make a new high. And if we get hit with the big shock, you could have an event where you dip below the 4,000. That would be an absolute accumulate moment for me. And it's one that's likely to be rejected violently. As with CV19, gold dips first before it goes much harder. So sometimes there's a flush out to the downside, and it kills retail, it certainly leverage traders, and it even gets a lot of investors miffed and bailing. And it's a great soft hands eliminator. You get a flush out to the downside. 2008, you fell to 690 before you broke 1,000, and you stayed above it, and you ended up running to 1927. CV19, same thing, before you made the 2021 highs. So people have to watch out for the complexity of price movements. As a technical trader, I wouldn't make the same statements as Michael, although I respect his rights to do that. There are a lot of things that could still transpire between now and the end of the year. I also, and I'll put a final nail on this before handing back, the call purchasing got a lot of people ramping. The calls are going, oh, people are buying $20,000, all part and parcel for why you'll be making a new high. The insiders know something. Believe you me, I'm with most conspiracies most of the time. There are insiders, there is a cacocracy, but I can say to you this, technically that doesn't look like it's real. And many people, once they've just had a blow off in gold and are holders that are got calls, will sell calls at 4.5, 4.7 to earn income just to the end of the year. This is option strategies. And people are only noticing the calls with these ridiculously high strikes. Why buy them if they're not going to happen? Because of capital management. If I buy if I write an unlimited call option, that means I'm short gold because I hold it, let's say, and I think, look, it's not going to do much till the end of the year. If I write a call at 4,800 and somebody buys it who thinks it's going to go higher than 4,800, I have unlimited risk, and the amount of margin I need to keep in my account is extreme. If I turn that into a call, a vertical call spread, and I actually purchase a call, even if it's miles out, I want to spend as little as possible. I don't care it's going to expire worthless. It caps the amount of money. You can get 9/10 of your margin back because it's no longer an unlimited loss. Just by owning calls yourself, you go from having unlimited loss above 4,800 to only losing a size loss between 4,800 and 10,000, 15,000, or wherever you're buying. So what you got was a lot of call writing after the blow-off high on what I would call a localized high during this period. And they've earned premium for that. So there's a lot of in the gold community and the precious metal community, there's sometimes a bit of BS on the bull side that needs eliminating. And I'm not in a hurry to be the Max Kaiser of gold, throwing out $1 million at the end of every year and never being right, but being the biggest cheerleader. All our targets have technical, chart-based, geometric, generated numbers that have come. We haven't sucked them out because they're big round numbers or they're headline seeking.
Well, Francis, amazing conversation. You shed so much light on the precious metal space for us today. Why don't you tell us about the Market Sniper and anywhere else people can follow your work online?
Sure. The YouTube channel, The Market Sniper, we focus on HVF method. I aim to achieve 3 things for everybody who watches. First of all, it's 100% free. You can subscribe if you like the videos. To talk as close to what I assess to be the underlying truth of the state of the global economy and what you should be doing about it. This is Reset Times. We coined and had in our brand the Reset Sniper before Klaus Schwab even used the name. It has the power off button when you're frustrated with your computer and you're done. That's my level of IT competence, by the way. And we feel that the typical traditional financial advice that's buy an insurance policy and 40-60 bonds versus equities portfolio that you typically have a sales commission-based rep come and flog you is not going to serve you for the transition from this failing system into the new system. The Market Sniper is dedicated to help you be reset proof to the highest degree on that. So building wealth during this, huge opportunities will come about through the distortions that have been created, although for most people they will represent crises. You can profit from that. You can protect those profits that you make, and you can also build a diverse optionality of existence across the planet where the downside will be more muted in areas not in the Western Hemisphere. And I am afraid most people in the West don't realize that this is coming hardest for them. As a Westerner myself, and you've really got to prepare financially. And that's the focus of the channel. So go and go watch on YouTube, also on X under the same @the Market Sniper.
Well, I will put links to both of those in the description as well as the Market Sniper website. Francis, as always, extremely enlightening conversation. Thank you for coming on.
Great to be with you, Jesse. Thanks for the invite.
Thank you for joining us today. If you like getting good prices on gold and silver bullion products, check out ARC Silver Gold Osmium. You can see some of their specials on your screen right now. These are subject to change, and well supplies last. So reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And we're building a WhatsApp community here on Commodity Culture. We've passed 120 members, I think it is right now. We've got people discussing precious metals, exchanging investment ideas. It's a way you can access me directly. I'm active on there as well. So if you have any questions about this episode or anything else, I'm happy to answer it. The link is in the description below. I hope to see you there, and I definitely hope to see you in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.